Request you to come here to this wall wherein we try and show some of the pointers that we wanted to bring out on this show. Now what we've tried to do via this is show you the markets over different business cycles, a virtuous cycle, a vicious cycle and a virtuous cycle. Mr. Subramaniam, before we get to the numbers, can you explain why we are calling these different time periods as virtuous and vicious?
Okay, so basically I want to start off, Neeraj, by saying that there are three certainties in life, right? There's death, there's taxes, and there's business cycles, right? So you can't be without. And what is the reason for that? Very simply, economic life is all about demand and supply, right? And it's a common adage that supply can come only in stages. Hero Honda can put up a capacity for a 25 lakh motorcycle at a time. He can't do 2.5 lakh motorcycles for next year's demand alone. Whereas demand, which is correlated to per capita income, rises every year. Everybody gets increments, everybody gets annual rises. It goes on a continuous basis. So the demand supply mismatch which occurs for two reasons. One, it's in stages. Second, four people jump in when they see a capacity mismatch and all try to put capacity, and when it comes on, it is surplus. So that's an inevitable part of competitive, capitalist economy, that cycles are there. Now, when do these happen? So clearly, if you can see capacity utilization in the economy, when it is underutilized, right? At that time, the cycle is going good. Because when supply is less than demand, the supplier sets the prices, and corporate companies are suppliers. So when they set the prices, their EPS grows up because they can expand their margins.
Pricing power.
You pricing power, and you enjoy that as an investor because you're buying those shares. So capacity utilization, if it is low, it means that there's a virtuous cycle ahead of you. When capacity suddenly become high and demand drops, either because of recession or whatever excess capacities, then the cycle turns, because then the consumer has the purchasing power. The consumer says, no, I'll only pay this much, and corporates could make losses or whatever. So when I say here virtuous cycle, this was a period when the economy was starved of capacity. Capacity was just being built, but Indian GDP went from the old Hindu rate 5 to 6 to an 8% plus level in this first spinner. What happened here? When do these cycles change? The very fact you cycle, it's like a cycle tire, right, of a cycle. It means that it goes around. So the typical thing is that in such a scenario, right, the inflation nexus with interest rates drives demand for rate sensitive products and builds capacity. That cycle generally changes in about 7 years. The reason I'm saying 7 years is because GDP, nominal GDP is about 12-13%. So in a normal demand, in 7 years time, 13/8 are 104, it would get used up. But there are factors like the Lehman crisis and all. So what happened here, the good cycle started, the Lehman crisis came, and suddenly there was a supply shock in the economy, and it became a bad cycle. When did this cycle change again to good? When Mr. Manmohan Singh started his reforms in October 13, and then Mr. Modi came to power, there was this whole thing, and oil prices dropped, thereby giving a supply boost to the economy. So that's what I mean by virtuous, vicious, and virtuous cycles.
Okay, now viewers, if go with an assumption or go with this, play around with us wherein we are saying that there were three cycles: virtuous cycle, a vicious cycle, and a virtuous cycle. Mind you, for the equity markets, there could have been within a virtuous cycle as well a pullback. That is a separate case altogether. But in terms of a business cycle, these were the three cycles that Mr. Subramaniam has identified. Now, look at these numbers and memorize these numbers, because the next plates we are going to talk about how different kinds of investing resulted in returns